Today, we're going to go in depth on one particular company, United Healthcare, a company under assault.
Starts with the murder of Brian Thompson at the United Investor Day. And I was actually there that day. It was a very scary time, but it created this negative, onslaught of PR from that day forward. But at that point in time, we were probably the most bullish on United until, of course, April happened. They reported first quarter, fundamental cracks in the business.
What has happened to Optum Health in terms of the U.S. government pricing, the change in pricing? Walk us through the whole thing.
Therein lies the issue with Optum Health. We dove deeper. We asked the question, how aggressive is Optum Health in risk coding?
United Health was much more aggressive than most others in terms of coding under the old system. The impact of the new pricing was much greater on United Healthcare than maybe other operators.
100%, and it could structurally impair Optum Health. And our view is that things could get worse before it can get better.
Today, I'm interviewing Michael Ha, the Managed Care Analyst at Baird. We are going to speak about United Healthcare, a company under assault. And that assault began in December of 2024, last year, when the CEO of United Healthcare's United Healthcare division was murdered by Luigi Mangione. So here's some highlights from the interview. Number one, the problems at UNH go far deeper than just rising medical care costs. Number two, the company's major growth driver, its Optum clinics, which service Medicare patients, are having real business problems. Number three, the problems lie in that the U.S. government has changed the methodology and the way that it pays Medicare patients and Medicare clinics. My guest argues that UNH is an extremely aggressive coder and that the changes in prices have impacted UNH far more than others. And lastly, this is really what the U.S. government is investigating the company is all about. Here we go. Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. Today, we're going to go in depth on one particular company, United Healthcare. And here to explore the entire United Healthcare saga is Michael Ha, the Managed Care Healthcare Analyst at Baird. Welcome, Michael Ha.
Thank you so much. It's an honor to be here.
Thank you. So, give us a little history. So much has happened. Give us a little summary since the beginning of December.
Right. I mean, it starts with the murder of Brian Thompson at the United Investor Day. And
right around here in New York.
Exactly. And I was actually there that day.
You were at the conference.
I was. It was a very scary time. And I mean, just for some context, we're all in the auditorium. We're all getting the notification at the same time.
So you were waiting for him to speak.
Actually, the first notification that happened, right, all of our Bloombergs were blowing up, and it said United Health Group CEO murdered. And we were all sitting here thinking, well, the CEO just left the stage.
So the CEO of United Healthcare.
Right. Well, Health Group.
Health Group.
There's confusion because the group CEO had just left the stage.
So the company's called United Healthcare, but there's a division, United Healthcare.
It's called Group, but then Healthcare is their insurance division, and that's Brian Thompson, right? So there's a lot of confusion, a lot of eventually sadness, and everyone was scared. But that was a really, of course, unbelievable day, very sad, very unfortunate. But it created this negative, onslaught of PR from that day forward. Over the next 2 months, the stock basically fell off a cliff, dropped, I believe, 25%. I mean, Bill Ackman was going at United on Twitter. So there's a lot of PR battle.
What was he saying?
About claims denials was his main topic. So at one point in February, the stock was trading, I believe, right around 440 off of 600. And it was United Health Group was, objectively speaking, the most hated company in the world. But the one thing here is that it was all really PR noise. There's no fundamental cracks in the story.
At that
time. So the stock bounced back, I believe, right back to 600.
It got to 600.
Right.
Right up to earnings season in mid-April.
Right. And things were looking amazing. The actual fundamental story was very sound. We were actually, like right now today, I think the reason why I'm here is because we're the most bearish on United. But at that point in time, we were probably the most bullish on United until, of course, April happened. They reported first quarter. And what happened is something we would have never expected, fundamental cracks in the business. And not just a revision of earnings, guidance for 25 lower, but
they didn't withdraw 2025 guidance at that point.
Not at that time.
They just lowered it.
They lowered it.
So I think the year began, people were estimating something like $30 a share. Where did it go down to from there?
Roughly like 20, 27, right around there. So a little bit shy of that, lower than that. But
so
over
not that
10%.
Big a cut. 10% cut.
But for United, historically, they've never cut in the first quarter. So historic for United. And where that cut was situated was Optum Health. There could be cracks anywhere in the business, health insurance side, Optum Insight, Optum RX, which I'll dive into. But because it was in Optum Health, their crown jewel, that's why the story has been unwinding.
Well, we're going to define all these things, but this was the crown jewel.
Right. And then from there, a month later, the CEO was stepped down, and the old CEO, the current chairman of the board, Stephen Hemsley, came up and replaced him.
And guidance was withdrawn.
Guidance was
Has
withdrawn.
that ever happened at United Healthcare, that they withdrew guidance?
I can't remember. I can't even remember. In my time covering them, this has all been pretty unprecedented, which is why at that point in time, in late May and June, with no guidance, a new CEO, management changes happening all over the place, investors didn't know where the floor was. And that's why the stock traded down roughly, like you said, down
from 600
50%.
to below 300.
Below 300, right.
Okay, so what happened when they reported second quarter earnings?
Right, so second quarter earnings, and it was worse than we expected. We were very focused on Optum Health, but what we saw was, yes, Optum Health got worse, but there were cracks everywhere else as well. In the health insurance business, in their healthcare IT business, in their pharmacy care services. It was spread all throughout. And earnings guidance was revised lower than buy-side expectations.
I think it's $16 now.
Right. And most investors were actually expecting somewhere around $18, $19. So even then, it was much lower. And now the question is, are they kitchen sinked? How does the path forward look? And our view is that things could get worse before it can get better.
Okay, so let's explore all these things. But before we do that, because I know most of my viewers don't know this company 1,000th as well as you. So let's lay out United Healthcare's divisions. Tell us all the businesses that they have and what percentage of the company it is, and then we'll go from there.
Absolutely. So I think the common misconception is that, it's United Health Group. They're an insurance business, health insurance.
I'm a customer, by the way, just so you know.
Same here under Baird.
Well, they're the biggest medical health insurance company in the country.
Exactly. But the thing is, they're no longer just a health insurance company. Maybe over a decade ago, they were 90% of their business was health insurance, 10% was what they call Optum, their non-health insurance business. Now it's flipped today. Only about 45% of it is health insurance, 55% is Optum, which I'll dive into. But on the health insurance side, it's broken up by really three main pillars. It's Medicare Advantage, so health insurance for seniors over 65. Then it's Medicaid for lower income individuals, and then it's commercial. Commercial, you can break it down by.
So you're on the commercial side because I'm sure your company uses United Healthcare for its employees.
Exactly. And the other side is individual, which most people associate it with Obamacare, the Affordable Care Act, individual exchange marketplace. Mm-hmm. And primarily the earnings exposure is Medicare Advantage, then commercial, then Medicaid.
On the healthcare side.
On the healthcare side, in terms of how much earnings exposure they have. And then on the Optum side, right, this has really grown over the past decade, and it's three different divisions. It's Optum Health, which is, you can call it their provider arm. People don't realize, but through Optum Health, they employ or are affiliated with about 100,000 physicians in the country. So for context, there's about 1 million physicians in the country overall. So
10%.
Roughly 10%.
So are these clinics that they own, or just clinics plus affiliated doctors, but it's all for Medicare Advantage?
Primarily for Medicare. So now we're going layers deeper with value-based care. But It is clinics, primary care clinics, which are really their crown jewel, but also they have affiliate relationships with physicians and multi-specialists, home health, a whole continuum of physicians, if you will. And a small piece of Optum Health is also Optum Financial Services, which basically operates as a bank.
And what are the other Optum divisions?
Other Optum divisions, you have Optum Rx, which is a pharmacy care services, where their PBM, their pharmaceutical benefit manager, you'll hear them called middlemen. Mm-hmm. And then Optum Insight, which is basically one of the largest healthcare IT companies in the country, the largest clearinghouse for claims between payers, providers, revenue cycle management, data analytics. And the way I would think of the split within Optum is if it's about 55% of its earnings is Optum, about 25% is Optum Health, about, let's call it a little under 20% is Optum Rx, and around 10 to 15% is Optum Insight.
Okay, so let's go back. 10 years ago, the company's 90% traditional medical insurance. That's here. Today, they're over here. Why? Forget about how the businesses are doing at this point. Why did United Healthcare decide that this was the way they needed to go?
Great question. And
this is a radical change.
Radical, right. And over a decade ago, everyone was perplexed as well. Why are you investing so heavily into a non-health insurance business? And the answer,
it was health insurance. It was not health insurance business. Correct. Okay. Sorry.
Exactly. So the answer to your question is really the answer to healthcare costs in the U.S., which is no matter what has been out there, hospital initiatives, pharmaceutical innovations, you name it, healthcare costs have ballooned out of control. They're 20% of GDP. Nothing has worked. So where the healthcare system landed about a decade ago was we need to impact change at the front gate. And who are your gatekeepers? Your primary care physicians. Because by the time you end up, for example, in the hospital, your health status has basically deteriorated to the point where you're going to be incurring a lot of costs and you're going to have to go to the hospital, end up in the ER. So instead of that, why don't we reimagine, re-evolve, and improve primary care? And how it looks is basically, I think, for a common person seeing their primary care, it's a relatively low quality visit. Let's say 30 minutes, half the time he or she's focused on you, the other half the time on the computer taking notes. But these new models, these clinics, as you mentioned, like Optum Health clinics, you're entering a 10,000 square foot center. You're met by an interdisciplinary care team of 5 individuals, a medical scribe there to take notes while the doctor can focus on you, nurses, or you have care managers. Some of these centers even have dentists, optometrists, cardiologists. They'll drive you to and from your home. Everything's powered by AI predictive analytics. And what we've seen is significant improvement in care. I mean, some of their most mature cohorts in value-based care, you see 50% reduction in hospital admissions, 70% reduction
because they're
in ER
getting
visits.
caught at the gate.
Exactly. Improving care right at the front gate, preventative care, if you will. So why that's important to United Health is because basically, number one is that they're seeing these models, these primary care models, bending the cost curve for the first time in such an effective way. And they're generating significant margins. You're talking, I've seen in the most mature cohorts for some of these models.
What do you mean by mature cohorts?
Yeah, so in these clinics, as you pick up lives, there's year 1, year 2, year 3 cohorts. As a senior is there for year 5 and beyond, they reach mature profitability, meaning their care has improved so significantly where their health is better. They're not going to hospitals.
So what you're saying is statistically, United Health could show you that this model, not only is it cheaper long term, but it's better.
Cheaper, better, exactly. My belief is that value-based care, right now it's synonymous with primary care, is that this is the best possible chance the U.S. healthcare system has in bending the cost curve long term. So now the interesting question is why is it important to health insurers, managed care? And I'll tell you right now, it's because, number one, health insurance is government regulated from a gross margin perspective, meaning at most, you can only make 15% gross margins.
Is that government mandated?
Exactly.
Okay.
Exactly. And they never do. They never make 15%. It's incredibly difficult to underwrite to that because there's always, flu season or COVID will pop up. So what they're seeing now is, wow, they're these primary care providers, value-based care that are managing care so well. Why don't we lock in our 15%, which we've never done before, right? Pass off the 85% over to these providers, and it becomes a win-win because those providers are then drinking from a fire hose of growth, and managed care companies are now locking in maximum profits that they've never done before.
So let me stop you for a second. So what you're telling me is, out of 100 cents on the dollar that is paid to healthcare, before, United Healthcare at most would make 15 cents on the dollar, at best.
Right.
And they actually never even made 15 cents, but let's give them the benefit of the doubt and say it's 15 cents. Now that they have the Optum clinics, they make the 85 minus their costs.
Exactly. So a lot of plans, Medicare Advantage plans, health insurers will just delegate that risk over to value-based care providers. But United, they had the crystal ball. They took it one step further and they said, why don't we just own the providers ourselves so that we can pocket the 15% and pass the 85% in-house
to us,
right, and extract what could be thousands of basis points of extra margin. So essentially what they had done was create this new earnings mechanism to unlock more profit and more margin on their existing base of lives. So we're talking millions and millions of lives. And this is why this is their crown jewel. This is why nothing else mattered, in our opinion, for United Health Group except Optum Health. And the one calculation I would give you is that if they were to convert 90% of their Medicare Advantage members, so they have around 10 million, and they have been, over the past 5 years, moving almost about 1 million of their lives into Optum Health. If they were to do that, basically for all their members, even extract 10% margins, 15% margins, which may even be conservative, that would double their entire enterprise earnings over the span of the next, let's call it, decade. And that's why it's so incredibly important.
So when did the market, you think, come to the realization that Optum Health is like the key to this company?
I think it really began over the past 5 years. If you recall, back in 2019, 2020, there were a number of IPOs. We're talking One Medical, Oak Street Health, a number of SPACs as well, Cano, CareMax, a number of value-based care providers that went to the market, public markets, and the veil was lifted. We were able to see the economics, the power of these business models. And these business models are exactly what Optum is, Optum Clinics, Optum Health. And once we began to see that, then we put it together, and we realized, wow, we see what Optum Health is now doing, and they have a head start, like a decade head start versus all their peers. And right.
So let's dig down a little bit. So when did the wheels start to come off in terms of fundamentals? Because I've heard on and off that there's been issues with respect to medical insurers for a couple of years now. It's not just the last couple of months. So take us through the sector for the last couple of years and what has started to happen.
Right. Great question. So after COVID, what we saw was an elevated utilization environment, meaning people were incurring more healthcare costs.
Well, they had put off their knee operations, and now they went for their knee operation.
Exactly. And if you recall, back in June of 2023, there's a lot of hype around pickleball driving hip and knee replacements. So pent-up demand, if you will.
So pickleball caused a spike in medical costs.
I'm not saying
metaphorically speaking.
Right. So what we saw was there wasn't just pent-up demand. Now there's actually persisting elevated utilization. People are actually utilizing the system more than they did during COVID or before COVID. And that elevated cost trends have been difficult for insurers to price every year. So what you've seen is pressure on earnings.
The insurance side.
On the insurance side, which, and I'll just emphasize, that is all a short tail risk because they reprice annually. So
let me pause for a second.
Right.
So in insurance, there's short tail risk and there's long tail risk. And it's generally better to have short tail risk because you can reprice. If you have very, very long tail risk, like long-term health care, you're stuck. So what you're saying is medical insurance is short tail. So if it's a problem, eventually they can rectify it.
100%. Exactly. So that's why during the last few years, even though there were hiccups on cost trend relative to pricing, healthcare investors would always buy the dip, especially on United Health, because they will price their way back out of this hole.
Right.
However, this time around, that's why it's different, because it's not just health insurance. It's Optum Health. It's structural issues with risk adjustment, which I know we're going to dive into, but that puts the entire model now at question and the go-forward earnings power of what we had laid out earlier.
So let's dig down into that. What has happened to Optum Health in terms of the U.S. government pricing, the change in pricing? Walk us through the whole thing.
Right. So I think in order to dive into that, I need to explain pricing at a higher level. So right now, the way to explain it is that Optum Health primarily takes care of Medicare Advantage, so seniors over the age of 65.
I got 2 years to go.
My father just aged in this year, actually.
There you
go. So basically how health plans are reimbursed, because remember, Optum takes 85% of the revenue health plans have, right? So how do health plans get reimbursed? Well, basically the government, it's a federal government program. They have their own actuaries. They've come up with a revenue per member per month. For an average Medicare Advantage senior, let's call it $1,000, so $12,000 per year. But it's unfair if your plan, you're getting $1,000, but your member might have comorbidities. They might have cancer, diabetes, AIDS, right? They'll incur more costs. So you should be getting paid more revenue, which is why there's something called risk adjustment, risk score. It's also synonymous, RAF as well. And it's a multiplier on your revenue. So if the average risk score of a population healthy and sick is 1.0, then it's 1.0 times 1,000. But if you do have these comorbidities, diabetes, cancers, AIDS, et cetera, you might be at a 2.0, 5.0, 7.0. And when you multiply that against 1,000, that's
a lot of money.
A lot of money. So how do you get to that risk adjustment score? Well, there's a lot of coding involved from the provider side. Providers will submit codes. I can get very granular, which maybe I will, which is so if you have a condition like diabetes, it's something called a hierarchical condition category, HCC, and cancer has one, everything has one, and they have a coefficient attached to it. A coefficient is basically, you add up all the coefficients, that makes up your risk adjustment score.
Okay.
So the simple formula is numerator, denominator. Denominator would be what's the average healthcare cost for a senior, and then the numerator is just the average cost of, say, a diabetes. So then if diabetes, and I'm making up numbers, is $5,000 a year, the average cost for a senior is $10,000, that's a 0.5. So in order to code to that, right, there are a number of underlying codes called ICD-10 codes, and basically that's how it works. And providers will submit claims, and then it gets mapped to ICD-10 codes that get mapped to HCC, and then they all get added up.
So I might have a plan that has a very sick population. So my average code might be 3.
Right.
And somebody else might have a plan where their population, for whatever reason, is a 1. So the 3 obviously gets paid 3 times more than the 1. That's sort of the concept.
Right. And that therein lies the issue with Optum Health, which is what after their first quarter earnings and they started to show cracks in Optum Health, we dove deeper. We asked the question, how aggressive is Optum Health in risk coding?
So let's talk about that. It's because what does that mean to be aggressive in risk coding? I'm a Medicare Advantage patient. I go to the doctor, they take my whole history, they check me out, they give me a diagnosis. From that point on, when you say someone is an aggressive coder, what does that mean?
Right. Great question. And even before then, people are probably asking, why does that even matter? Well, it's because there were risk model revisions put in place through the Biden administration, through CMS, and it's called V28 risk model revisions. It kicked off in 24, 3-year phase-in, 24, 25, 26, equal parts. And what it essentially did was everything we laid out on risk adjustment, right, HCC, ICD-10 codes, it made it much more difficult to code to that HCC.
What do you mean HCC?
The hierarchical condition categories with the coefficients attached.
Mm-hmm.
So it basically removed the ICD-10 codes that would map to that HCC, a couple thousand.
So they eliminated 1,000 illnesses, so the way you would code for an illness or a problem or a concussion. Why? Why did the government do that?
They removed codes that they thought weren't accurate, that were, I guess, prone to being aggressively coded, discretionarily coded.
Give me an example.
So, I mean, there are a multitude of things, right? I'll tell you, for there are a few parts to this. Not only did they remove ICD-10 codes, but they also constrained the HCC codes that were above it and made them all equal weight. Because before, there were different coefficients for like a condition based on severity, like diabetes with chronic conditions with complications versus acute conditions with complications or without complications. Now they're all the same weighting, for example.
Okay, so you're basically telling me I could have one patient and two different doctors come in to examine the patient, and they basically have the same diagnosis, but if a doctor wants to be aggressive in coding that patient might be a 3, and the other doctor might make it a 2. Is kind of what you're saying. There's discretion in how you code someone, how you categorize it, et cetera.
There is a lot of wiggle room and discretion. And I mean, there are other, like a very easy to understand example would be, there used to be a severe head injury, HCC, and a major head injury, HCC. The severe head injury is no longer there. And now you have 3 different major head injuries that are much more specific to code, and they're worth a lot less individually.
I think I read you said one was severe head injury, but patient was always conscious. Right. Severe head injury, patient was unconscious for, let's say, 10 minutes and then for more than an hour. So it was much more specific, much harder to fudge the system.
Exactly. So I'm not saying, so we're naturally going to segue into the Wall Street Journal articles on United, the DOJ investigations. And I'm not saying for them, I think they're trying to figure out whether United Health and Optum Health has been doing things fraudulently, improper coding. I'm not necessarily saying that at all. I'm just saying the prior risk model program had a lot of wiggle room, a lot of discretionary areas.
Right.
And now it's much tighter. But United, in that previous risk model program, they were coding more aggressively. And
so
that's what
you
we're
put
seeing.
out a report. Let's try and quantify that a little bit. In the reports that you've written, how much more aggressive did you find United to be in terms of coding, and what kind of work did you do to figure that out?
Right. Great question. So back in June, when we downgraded United to neutral, what we did was we set out to find out exactly how aggressive they are, and we pinpointed one market in particular, Los Angeles County, which is one of the most dense Optum Health markets, where they have basically 3,000 employed Optum Health physicians in that one market. And even more important is that we know when they acquired those physicians. It was 2019. They made a large acquisition of a company called DaVita Medical Group.
I remember that.
Right, and they were previously called Healthcare Partners. So what we did was then we did a 10-year trended analysis saying, okay, 2019 is when they acquired them. Let's look at the 5 years before and then the 5 years after on how risk coding trended. And the 5 years before, risk codes barely moved. It was flat. But the moment they acquired those assets, it increased from what we saw 1.01 to 1.5, which is considerable. And one could say, okay, what if they picked up more lives that were, more frail? Well, we looked at a number of different metrics. We looked at low-income members as a proxy for frailty, and it didn't look great. We looked at LA County.
When you say it didn't look great, what do you mean it didn't look great? I mean, it didn't change that much.
Meaning their members were actually, there were less low-income members, like 20% low-income members, making it 1.51, versus the rest of LA County, excluding United, was about 1.46 on higher, like 30% low-income members. So if you were to put them together or side by side, not only if you want to say they played catch up, they went even more aggressive because, yeah. So that's a significant increase. And basically what that suggested to us was that, okay, V28 risk model revisions, we've seen around the country, there are a number of providers, particularly in South Florida. And when I say South Florida, the two most mature health insurance markets are California and Florida, which means if they're most mature, they are the most aggressive and the most sophisticated when it comes to things like coding. Well, there were value-based care providers in South Florida that are no longer around, put out of business because of V28. And if United and Optum Health was anywhere near that level of impact, then times were going to get very difficult. And that's why we downgraded. And in July, in their second quarter earnings, they lowered their long-term margin target for Optum Health.
From what to what?
from basically 8 to 10% down to 6 to 8% as a Optum Health division.
6 to 8% what? Growth, revenue growth, or earnings growth?
That's operating profit margin.
Operating profit margin.
Right.
So if I could just sum up your thesis in like a paragraph, tell me if you agree with this. What you're saying is the new V28 coding made it more difficult to be aggressive in coding. So therefore, prices in a sense came down. But because United Health was, let's say, much more aggressive than most others in terms of coding under the old system, the impact of the new pricing was much greater on United Healthcare than maybe other operators.
100%. And a way to maybe think of the magnitude of impact, we just mentioned Optum Health, their long-term margins were 8 to 10%. Well, what they just announced in second quarter, which
is 6 to 8% now.
Which 6 to 8%, but the impact alone from V28, they finally gave us disclosure. And United historically is a company with very little disclosure.
Oh my God, the disclosure is appalling.
Right.
It's appalling. I'm going to talk about that in a second. Go ahead. Please, go ahead.
Right, exactly. So they gave us the impact. I'll say the numbers. It's $11 billion over 3 years. Well, what that translates to is roughly close to 20% rate impact over 3 years on a business that long-term does 8 to 10% margins. So if the ceiling is coming down on risk adjustment
by 20%,
by nearly 20%, where are you going to find the offsets? Remember, these are clinic models that are optimized, right? Tight staffing models, optimized to deliver the best care. There are very limited offsets. And that's why I mentioned the models in South Florida that are no longer around, because there were no offsets. And it could structurally impair Optum Health. It could structurally impair everything we mentioned about.
So you're worried that the margins will be lower than 6 to 8%.
I'm worried, right, exactly. And right now, there's incredibly high execution risk in finding the offsets, which they haven't done in the last 2 years, and then rebuilding unit economics. Remember, we're not out of the woods yet. V28 is a 3-year phase-in. 2026 is the last year. So we're heading into another year where if it's 20%, then it's 6 to 7% per year. And where are you going to find the offsets? But
by the way, just to interrupt you for a second, if it's 20% for United Healthcare, other companies that are doing the same thing, what have they said?
So for other companies, it's much, much smaller of an impact.
This is important.
Yeah.
How much and why?
Right. There are a couple things to understand here. Number one is that in terms of Optum Health, for the last 5 to 10 years, their advantage has been that it's such a big part of their earnings, a growing part that's roughly 25% of their business now, while every other company, it's much, much smaller. For example, we mentioned Oak Street. CVS bought Oak Street. Mm-hmm. It's one of the bigger value-based care providers in the country, yet it's only about, 2% of CVS's enterprise earnings. And that's the next biggest competitor. Humana as well, it's roughly a couple percent. So even if you were to say a 10% margin impact on that, it's very minimal. So,
but for the other companies, it sounds like it's been a less of an impact.
Seemingly less of an impact, or if it is an impact, then
it's a smaller part of the company.
It's a much smaller part. I would say for Humana and CenterWell, they're value-based. It's basically their equivalent to Optum. They've done a terrific job offsetting V28. That's because number one, the impact is much lower than United's. Number two, their providers, if you think about Optum Health, there are 30,000 primary care providers all around the country. Less than 10,000 are actually directly employed receiving a salary. The other 20,000 are affiliated, loosely, they have loose relationships contractually, but it's very difficult when you don't have a centralized physician base to then navigate, come up with cost savings, or even recoding behavior across that base. So it's much more difficult to Optum Health. I think they've quite clearly misexecuted, underappreciated the impact, and now the bar for execution is incredibly high. And I think there are limited offsets. So ultimately, I think it's going to be more difficult. And I think the turnaround is going to take much longer. So this is all boiling down to when investors call me about oh, Mike, you're wrong with your underperform rating. This is
Gee, I never got calls like that when I was on the sell side.
Right. Especially with
Go ahead, it's new to me.
Right. So especially with Berkshire buying a position.
By the way, the Berkshire position, though, in your defense, is quite small relative for Berkshire. This is not a big position for Berkshire at this point.
Right. It's not a big position. Also, they bought into the position before they reported second quarter. Second quarter was very important because of everything we mentioned. Mm-hmm. So that's notable. Also, ironically, we would put United Health in the too hard pile, which Warren and Munger have been historically known for.
Too hard to invest in.
Exactly.
So what are those conversations like when people yell at you and say you're underperforming? As if you changing your rating would have that much of an impact on the stock more than one day.
Right.
No offense, but having been on the sell side, you have an impact for a couple hours. That's it.
100%. But I would say everyone says the same thing. There's been a lot of generalists reaching out saying, Mike, you're wrong. They're a health insurance business, short tail risk, annual repricing, they'll bounce back. It's 50% off. They're going to get back to where they were. But the moment I start to talk about Optum Health, V28 risk model revisions, structural impairment, they say, okay, I'm sorry, I didn't realize how deep this goes.
It was so complicated.
It's so complicated, exactly.
So let's just turn quickly just to the healthcare business because, yes, it's short tail, but they're still having troubles catching up. Why are they having – that's unusual. For short tail businesses, generally, you figure out what's wrong, you reprice, and you're done. So why has it taken what should be much shorter period of time so long for them to get their act together here?
Right. I mean, there's so much of United Health where the story doesn't add up. And the reason why I'm saying that is because heading into 25, for Medicare Advantage, let's focus on that because that's where 70% of their cost issues are in health insurance. Well, number one, all the other health insurers are fine on pricing and trend except United Health. And when you were to look, the number one thing to look at heading into the year is how rich is United Health's benefits, right? Is it rich relative to peers? If it's richer, generally more people will utilize your insurance. Well, for them, they weren't that much richer. They actually reduced their benefits. And if you were to look at it and compare it to national benefit richness, they were more conservative. So the fact they're getting hit left and right by utilization, it's perplexing. It doesn't quite make sense. And I mean,
do you have a theory?
I have many theories.
Lay it on me.
Where do I even begin? Well, anecdotally, I have heard from a number of people, providers, that ever since December, right, Brian Thompson, the claims denials, that they have been easing their denials and letting more things get authorized as well. It's something that I have a suspicion that might be driving their idiosyncratic, right, pricing trend issue. And I mean, there are other theories. Maybe I'll just hold off on that. But I do want to point out one thing, which is one thing that has not sat well with myself and with investors as well, is that they had been recognizing gain on sale of assets within their numbers for the past 2024 and 2025 without much discussion around it.
So they were including that in part of operating earnings?
Right, exactly.
So let me explain that because it's outrageous. So in other words, United Healthcare would sell a part of the company, a division, and let's say they book, I'll just make up a number, 25 cents a share gain after tax from selling the division. Now, for a financial services company, you do that. That is not part of operating earnings. So you're saying that they were including it basically as part of the operating earnings of the company and they weren't telling anybody?
And it wasn't just 25 cents. It was $3.
$3? Out of what?
It's over $3 billion, $3.3 billion. And last year they did earnings of roughly, let's call it $27. So
$3 out of $27 was from selling a division of the company, and they didn't tell anybody that this is about $3.
Selling controlling stakes within their Optum business, and then just including a line within their 10K about it, which, I mean, it's
like go fish for the analysts. Go find it.
And they hadn't talked about it. They may have mentioned it briefly in their earnings call as portfolio actions, but it was very vague. So if you were to strip that out, that was their entire earnings growth year to year in 2024. And
it
then
was from the gain on sale.
Basically, right? $3. So then let's fast forward to today.
Yeah.
In second quarter, they stripped out. They said they halted portfolio actions, which meant stripping out more gain on sale of assets that were embedded in 2025 guidance. And it was even more than last year. It was roughly, I believe, $3.65 billion, north of $3 EPS once again.
But finally, they disclosed it.
Well, yeah, they disclosed it, and it was, just alarming. I mean, it didn't sit well. I think.
Oh, it's more than alarming. It's a sham.
It also coincidentally, fun fact, and this is my associate.
You sound like my son. It's exactly what he would say. Go ahead.
Yeah. Fun fact is that if you were to add up the V28 headwind, it's $11 billion over 3 years, so roughly north of $3 billion per year.
Right.
It almost seems to match exactly with the gain on sale of assets. And if
they were offsetting the V28 with sale of assets.
I mean, this is
your thesis.
My thesis, my suspicion, and there's a Bloomberg article. They named it stealth sales from United, and they are saying that they sold controlling stakes within their business to Warburg and KKR with the promise that they would buy it back at a higher price in the years to come.
Oh my God.
So
wow.
It's things like that are masking,
the underlying
fundamentals. And I mean, I have so many anecdotal data. I mean, we spoke to someone who worked at strategy in Optum, and he had told us that, and this is something that we had been suspecting as well for a long time, that he told us, take a look at the intercompany dynamics. He said for a number of years, Optum was charging United Healthcare on the insurance side, up to 2x the rates they would charge external providers or clients. And they were using United Healthcare to cross-subsidize the underperformance across Optum Health, RX, Insight.
Say that again more slowly, because I want to understand that better.
Right. So what this industry contact was saying was that he would urged us or suggested us to take a look at their intercompany dynamics between Optum and United Healthcare, the insurance business. Right. And he's saying basically Optum Health, or Optum overall, including Optum Health, was charging the insurance side, because there's a lot of overlap, right? The members here are going here, and they were charging the insurance side double.
So they were
rates.
making Optum Health look much more profitable because the market pays more for growth on Optum Health.
Exactly.
When it was really just an intercompany transfer.
Exactly. So,
I see.
It's interesting because I watched your interview with Steve Tusa.
Did you really?
About GE, and I think he was mentioning something about the turbines and the Alstom, I think, and how they were something about extending the useful life and then selling the receivables to GE Capital and then making
so
cash gains.
they would instead of selling something, they would do a financing with GE Capital and call it a sale. When all was happening was money was moving from here to here. It's all within the company.
So it reminded me of this dynamic. By the way, this is just my suspicion, anecdotal data points, nothing that's confirmed. Just want to mention that. But it's a number of things like this. It was also this.
Let me add a thing.
Right.
The disclosure of this company is appalling. I mean, look, I know banks. So when banks report, you get like the earnings release. That tends to be about 10 pages long. And then you get a supplemental deck, which is about 40 pages long. Right. So like every possible conceivable number that you want is in that deck. You know what's happening within that company by overall, by division. You have almost every possible statistic. There's nothing hiding. So if the company is doing well, you know why. And if the company is not doing well, you know why. So when I was reading your reports, I said, let me take a look at the press release of United Healthcare. I was like, it's 2 pages long. Where's the rest of it? This is a $300 billion market cap company. I would say this. There is no way from the data that this company gives that you can really model the company. I mean, you can model it, but you can't really model it in a granular way so that you could say, my model is telling me what's happening in this company.
Right. And I'm glad you brought that up because investors have always thought that. But over the past 15 years, United has delivered 15% EPS CAGR without any struggle. So why question a business on the opaqueness of the reporting when?
By the way, that does actually remind me of GE. So the old GE, when they would report, they would break up the company into divisions. So GE Financial, which is perhaps one of the most complicated companies on planet Earth, had about 5 lines. Oh. That was it. It was like revenue, expenses, pre-tax income,
right.
And that was it. And you're like, what am I supposed to do with this?
It sounds very familiar to like Optum Health, a $100 billion revenue business where we don't know the components of. We're starting to figure it out, value-based care and the bank side, but it's very opaque. We need a ton of additional disclosure.
Do other companies get better disclosure in the industry?
Incrementally better.
But not great.
Better. Not great.
Okay.
Exactly. Yeah, it's a really great point you made. Actually, GE.
I was shocked.
Yeah.
I was shocked. $300 billion, once a $600 billion market cap company, had disclosure of like 4 pages long. It was ridiculous.
And I know GE also acquired a ton of growth over
many years.
Many years. I mean, there was an article from someone named Wendell Potter. I think he was at Cigna in communications. He has a Substack, and he published a report looking at the number of subsidiaries in United Health. And I might be wrong, but I believe it was about 140 over a decade ago. And now today it's like 2.7 thousand different subsidiaries.
So, maybe part of the problem with this company is it's now so complicated, even the management may not completely understand what's going on.
So our contact who worked in Optum and strategy mentioned also potentially like fundamental cracks within the management team just because of how large it is. And also what happened with Brian Thompson, unfortunately, created shifting within the divisions before they were ready. Usually they do 2 to 3 year rotation. So there's a lot going on within the management side.
So when do you talk to the company?
Mm-hmm.
Like, what do they say? Or do you talk to the company anymore? Or maybe they're not talking.
Probably not after this. So, right, we do speak to the company. What do they say? I mean, they continue to remain confident that they have the levers to pull. It's difficult because over the past 12 months, we're confident, then something happens. We're confident, then something happens. And
I will say this, with my opinion, with the disclosure, I don't think anybody can have a strong opinion about how well this company could possibly do. There's not enough data.
Right.
You don't even know within the numbers, like, if this number gets better, that's how with banks. If this number gets better, like if credit quality gets better, the bank gets better. Then you don't have enough data in here to even know where to begin.
Right. And if there is intercompany dynamics, then it's the shuffling of earnings and masking of underperformance. So if, like for example, Berkshire, if they are betting for 8-year duration, right? My pitch right now is that things could get worse over the next 12 to 18 months. But over time, eventually earnings will trough, and then can they rebuild unit economics? If Berkshire is making that bet, great. They could potentially do that for sure. But then if the real question is,
what's bottom?
What's bottom? Is Optum Health structurally impaired? Does their value-based care model actually work, or has it been masked by aggressive risk coding, gain on sale of assets, right? Intercode dynamics? Can they re-accelerate and drive those cohort, maturation economics we talked about that could unlock embedded earnings, or is that now impaired? And what's really important to understand is into the back half of this decade, health insurance, which has been a beautiful organic growth story because of aging baby boomer demographics, everything, that's slowing. By 2030, that's the last year baby boomer can age into 65 and qualify for Medicare Advantage. And the penetration rate on those members in Medicare Advantage will be near peak. So there's going to be a step function decline in health insurance growth and Optum was purpose-built to offset that going forward and usher in a new future. But if that's impaired, then the model...
So you have no idea what Optum Health margins could possibly look like at this point?
I mean, I have an idea.
Well, give me an idea.
Well, right now they're saying it's 1% margins right now, value-based care.
I thought we were 6 to 8.
6 to 8 long-term target margins.
Right now it's 1?
Right now, value-based care. So, all right, a couple of things right now. 6 to 8 is Optum Health.
Right.
Right.
All the divisions within Optum Health.
Right. Value-based care is 65% of Optum Health. and they're saying it's operating at 1% margins right now.
So the Optum Health clinics, that type of stuff, is only a 1% margin. Where was it?
That's a really good question. Well, they're saying long term, their target margin now on value-based care is 5%. Before, they were telling us it's, I believe, high single-digit margin. But it's hard to understand because if they're getting hit by nearly 20% rate headwind on V28 and they haven't offset anything, how is it possible they're still doing 1% margins? And I mean, I can go down a rabbit hole in that as well, but I think there's...
Let's not go there.
Okay. I can get really deep on the numbers, but yeah. But yeah, I think margins are pressured. And remember, it's going to get worse in the next year. So they need
because there's another year of pricing.
Exactly.
So let me ask you a different question. So you've gotten a lot of calls from people who are positive, and most of them kind of back off because they don't understand how complicated this is. Have you come across someone who's positive who understands how complicated it is?
I want to say no. And
a lot of knowledge can be dangerous.
Definitive no.
No.
I've been marketing, traveling all around the country, even just the past month. Every healthcare dedicated investor, Mike, I agree with you. The next 12 to 18 months is going to be tough, but multi-year, over 5 years, can they get back? Then I say to them, okay, they could get back, but they're also cleaner stories. Like all the answers, the questions you need answers to are very difficult. There, on the flip side, there are stories within managed care that are much cleaner thematically, just their growth path.
So my personal opinion, unless this company dramatically improves disclosure, I think it's very difficult to recommend this stock.
Right. We would recommend it with caution. If you do want to buy United, I would say you better have multi-year duration.
But right now you have an underperform on it.
We do. So for over the next year, we think there's going to be more issues and things could get worse. And then I would also pose the question, like even in our bull case scenario, right now the stock's trading at 305. Our bull case scenario is 257, so call it 15% downside. And that's very, very optimistic, rosy estimates on EPS growth next year, assuming they can offset all of V28, still do high single-digit EPS growth. And then in 27, they do their long-range plan, which is 13 to 16%. Discount it back a year, put a 14, 15 times multiple, which I think is really the new normal for United. United used to be, let's call it a 20 times PE story that was expanding because of Optum Health. People are no longer willing to give them a 20 times multiple. And even then, I think that's why even my bull case scenario implies downside. So,
well, this has been great. And so I've certainly learned a lot, and I hope our viewers have too. Thank you, Michael.
Thank you so much.
Really appreciate it. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.